Hello and welcome to KYC. I am Sharad Dubey and let's start the show. Of course, in KYC, we'll be giving you some hints before we disclose you the company which we'll be discussing in our show. Of course, let's see the important hints. It's a recently listed company. It was just listed in December itself. The history is very less, but nevertheless, we have taken out the data to judge the company in KYC. It's into precision manufacturing. That's pretty much interesting. Also, another hint I would like to give you. They operate in both consumer and the aerospace as well, but mainly in the aerospace. That is where the interest is coming of everyone about this company. It's largely a untracked company, newly listed. Let's see what happens. The third one is it's backed by Amansa Investments. I saw the shareholding pattern of this company. Big name here, Amansa Investments, futuristic, aerospace. Very much interesting because of a manufacturing angle as well. These are the key hints for this company. But recently listed company, Q3 numbers are also strong. So I would like to disclose the company for KYC, which we'll be tracking today. And the company's name is Aequs. This is the company I'm talking about, and they have ecosystems of efficiency. That's what the company claims, aerospace as well as consumer segment. And we'll be looking at this company, at what actually the company does, and is there a path to profitability angle as well or not. The first question is, why are we calling this company and why in KYC? It's a unique company. I saw the product portfolio. It was pretty interesting. The engineering-led vertical it is, and it's into integrated precision manufacturing. To put that in perspective, it's like an all-in-one kind of a setup. In simple words, aerospace order book, that's at around $840 million. That's pretty interesting as well. And it has been approved from MeitY for PLI under Electronic Component Manufacturing Scheme. Also, apart from this, they have added Mattel as a consumer segment customer. This is, of course, in the toy segment, which is in the consumer business. The manufacturing operations, apart from Indian clusters, the industrial clusters which the company has, is also USA and France. And France is a very important kind of situation because of the India-European trade deal completion. That's where the company might have an advantage. But looking at the utilizations, still it's not very convincing. It can go up. Aerospace is 71% and 31% is your consumer business. That means there is a big runway for capacity utilization. And when this happens for a company, always remember that a larger capex plan can wait. And already recently the company came out with its IPO. Let's look at the business segment reporting, and this is all the revenue breakup which I'm talking about. Aerospace is having the major chunk, that's roughly 86%, and on the other side consumer business, that's roughly 14% here. It's growing right now, and of course when something has a small base, the growth rate is higher. That means the consumer business mathematically can grow much faster than the aerospace business. Export and domestic, this is the outlook. 90% of that is coming in exports. It will be pretty much interesting to understand which countries the geographical difference is, and is there any pain because of the global tariff issues which are happening from US, or some benefits come in from the European Union FTA deal which is already completed. There are Q3 key factors. The exceptional losses were there which dragged the PAT numbers. So company is still not profitable yet, and Street is kind of concerned because of that. Margins had dipped on a year-on-year basis. That's also something we'll watch out for. But let's judge the company on a 9-month basis to give you a longer-term picture as well. Aero segment business has remained strong. The strength is coming in. That's the core business of the company. Now, amongst the guidances, the strategic shift is happening to become a system-level contributor in the defense space. Some new JVs are being formed, and that's what the company is also reported, and we have taken consolidated numbers to give you a simpler analysis. Apart from this, the aerospace growth, that's expected to grow in at a rate of exceedingly roughly 20%, and that'll be pretty much interesting as well. Earlier guidance pointed to overall PAT positivity by FY27. It's likely that this might be stretched later as well. That's when we'll confirm these queries from the management. That's something which is the overhang in the stock. Long-term EBITDA margin guidance is roughly 20% plus for both the segments, and that'll be pretty much interesting as well. So this is the overall, we could say, the kind of rating parameters which have come in. But overall, there are 8 of them, and we'll be talking about the income statement, the balance sheet, the cash flow, and even the return ratios. On the other hand, also there are some new parameters I have picked in because the company is having, we could say, a very kind of a limited, so share period. There is shareholding, there is operational parameters, street cred is also there, and even outlook has made it to the list. So we will be talking about these important 8 parameters going ahead. So let's talk about the first parameter. The first parameter is the income statement, and in our analysis I will be giving you the 9-month numbers for it to give you much more better perspective, because the company itself was listed in the month of December. So to be fair, to be honest, Q3 numbers are definitely there, that's what the street reacts, but 9-month numbers are also strong. Good contribution from the aero segment, and the growth is coming in. Revenue is at 948 crore rupees. The margins front, that is where the story gets very interesting for this counter. It was at 11% for 9 months FY25, and that has gone up to 15%. That means we are seeing some value addition benefits coming in. We are also seeing the backward integration, because the company is stating that they are looking in for the whole ecosystem as a whole, and that is where the growth is coming in. Net losses, that has actually reduced, but that doesn't mean that the company has turned profitable, and that is where the overhang comes. That means you need to wait and watch for a counter like this, because it's not profitable yet, and a manufacturing company which is not profitable doesn't digest well with the long-term investors. But net the income statement is good, and we take Q3 numbers with a pinch of salt. Then overall the income statement, I will give a strong thumbs up. Apart from the income statement, let's talk about the balance sheet. And balance sheet, I have tried to simplify it this time. Earlier we used to give you the entire last 3 years numbers, and it got very confusing. So a lot of viewers wrote to us that, Sharad, give me the most important parameter to look at, and I have given you this parameter today. That's the net debt to equity. I have been seeing the numbers, and of course remember this big reduction which has come in. This is on account of IPO proceeds being applied as well. The balance sheet, you could say the life or the health is strong, and because of that I have given a strong thumbs up rating as well. So 2 fundamental rating parameters on the numbers, they have done really well. But has the cash flows also picked up? Cash flows are lumpy in nature also, so I have got them together for the 9-month basis. And cash flow from operations, there were some issues in 9 months FY25, but look at that lumpiness here. 44 crore rupees is coming in the market, and for a manufacturing setup, if the cash flows start coming in, that is a very good point. And the same story is being repeated for the net cash flows as well. Of course, this larger number you can see is coming from the IPO proceeds as well, and that capitalization and the cash flows, that is where it might change the trajectory of this company going forward. Because of that, the cash flows also I have given a strong thumbs up. Apart from the cash flows, let's talk about the return ratios. Has the return ratios been delivered yet? So ROC, we have taken it for the aero segment. They are totally 2 different businesses, so better to make analysis for one business at a time. 14% in FY24, there was a dip, 9-month FY25, but then again it's back, and that's what we saw in the earnings numbers also. The management commentary also has been bullish. That's around 19% of the numbers in the return ratios which are coming in. When you talk about the consumer, it hasn't picked up yet. It's still in the negative. It's trying to break even in majority of these return ratios. So the consumer segment needs time, and it's we could say in a baby kind of a stage right now. And the return ratios on the ROE, that is, as an investor, if you are there in a company like this, you should be demanding something between 12 to 18% of that at least, and that hasn't come yet. But yes, from -15 it has kind of improved to -4%. So we need some more time, maybe 1 quarter, 2 quarter, 3 quarters of weightage would be there, and if that changes, then it will be strong. But overall, it's a neutral rating when it comes to the return ratio. Apart from the return ratios also, let's talk about other parameters when we judge a company in the KYC. And after this is, of course, let's pull out the numbers, operational numbers. They are also very much important. And I'm talking about lower capacity utilization, and that's why the fixed asset turnover ratio, that's actually coming down. And generally it should be 75 to 80%, and because the company is having a sizable order book. But remember, they are into aviation. These order books are high gestation period order book, so it takes time. Because of that, maybe there is a lower capacity utilization, and the net working capital days, that has improved, and that's good. It topped in 9-month FY25 at 143 days, but then it reduced. And when this working capital reduces, the cash flows also improve, the liquidity ratios improve, and that is where the strength is coming in. So one parameter, there was an issue. Another parameter, there is a strong up move coming in. So it's a neutral rating I would give, to put that in a very balanced view when it comes to the other operational numbers. For Aequs, let's look at the shareholding pattern, man, because this has just been recently launched, so there isn't a history about it. And to be fair, it's not fair for the company to judge on just one parameter, and that's what I make sure that independence is there in our KYC show. The promoters over here, it's almost 60%, nicely capitalized, but FIs, DIs have also participated. And for a market cap company like a 9,000 crore, it's a decent amount, I would say. That DIs are having 12% stake, while FIs are having 4%. So institutionally, 16% stake is there, and that's a good, healthy sign as well going ahead for the company. So net-net, it's a neutral rating for the shareholding pattern segment. Apart from that, let's talk about how the other parameters are important, and we will be getting a lot of details on that. And shareholding pattern is something which we have already done. But apart from that, let's look into the street cred. The IPO price was 124 rupees. There was a listing pop also, and the listing pop came in to be at around 140%. That was a 13% listing gain. But the current stock price is below both of them. And that is where slight concern is there. It's not a major concern. It's almost flattish. So whoever has entered after the listing, there's nothing made for them. Whoever got it at IPO price, it's now cheaper currently, and there is an impact on the Q3 numbers. So I would say, for the time being, for a very limited period where we are judging the company, it's a thumbs down from my side when it comes to the street cred. Apart from the street cred, let's look at the outlook. They continue to increase their wallet share with the existing customers, and that is where your benefits also come in the margins front. Also, looking at the expanding portfolio of the consumer electronic products, the company has just started. I was just seeing the portfolio. There's going to be a lot of cross-selling. That's what it looks like. And going ahead, the value-added manufacturing, that is where the management focus is there. So all across, these are all the levers which actually increase the margins of a company for even a long gestation period in which the company operates in. The aerospace order book is strong, $814 million. Yes, that's the amount. You have heard it right. And that's what we'll be looking at. But net, it's still a neutral rating, because always the question remains is, a company profitable kab hoga? That's the important tagline for it. And let's give it more time so that we get that numbers on the bottom line numbers. And that is where the street will come in when it comes to the future growth outlook as well. But apart from this, we have spoken a lot about this company and what it can do going ahead. But what is the total rating parameters which we have given? What's the final KYC rating? That's also very much important. And we have income statement, balance sheet, cash flow, a very strong thumbs up coming in for them. But return ratios, they are kind of giving, different signals. Street cred, nothing much there. It's trading below the IPO listing price. And these are the other metrics you should be looking at, a neutral rating. But still, the final rating is still on the higher side, 5 out of 8. For Aequs, KYC's rating we have given in, and that's largely a stronger one. But now we will be joined by the management, Aravind Melligeri. He'll be joining us. He's the MD and the CEO of the company. He has a 30-year experience in this sector. He's also the co-founder of Quest Global, I checked, and an impressive education from Pennsylvania State University and NIT Karnataka as well. Joining us is Mr. Aravind Melligeri. Good afternoon to you, sir. Impressive set of numbers if I look at the 9-month numbers, but query is the path to profitability. You had spoken about FY27 and being profitable for the company. You're going to stick with that guidance as well?
Yeah, I think if you really look at it, the profitability, aerospace is profitable business. It's a mature, profitable business, and our consumer is the one where the profitability, is yet to be seen. That is because of the capacity what we have invested over the last 24 months and the utilization which has just started improving. Because what it takes sometime when we enter consumer electronics, it's a long gestation period to prove out the parts. And for us, aerospace, it took about 15 years to to mature this and where we are. In the consumer, we are just consumer electronics, especially we're only 24 months into this business, and we invested over last 24 months into this vertical, and utilizations have just started picking up. Last quarter, Q3, we just started shipping 2 products, which for a consumer electronics customer, and both are approved and now started generating revenues. That's why you started seeing utilization improve also in the quarter on the consumer electronics side to 31, overall consumer to 31%. And whereas aerospace already were 71%. So utilization is high. When the manufacturing business, as you mentioned in your earlier statement, the utilization drives the margins. When our utilization gets to 50+% in the consumer side, you'll start seeing the profitability showing up in the overall perspective. And the negative what is getting contributed from the consumer electronics will make sure that our overall profitability will be positive. So with timelines, what you're talking is in line with what we are expecting. At the same time, our consumer customers are demanding us, hey, you're doing well, just capacity, can you expand more? That's the
Right.
question we need to figure out.
Right.
When do we need to?
Yeah, Mr. Melligeri, that's a very important point. So that means by FY27 and the company will be profitable. That's what we spoke about. But Mr. Melligeri, another query definitely comes is the capacity utilization. The capacity expansion generally a company does is when it's around 80, 85 or 90% capacity utilization comes. Currently, it's not there at that level, sir, to be honest. It's at around 71% for your core business. And okay, we understand the consumer business, that's where the capacity utilization is growing. But net, what kind of targets you can give for next year? Will it be on the higher side, or how does this actually work? Because these are all long gestation period contracts. And when do you recognize, these capacity utilizations? Just give us that perspective.
If you really look at aerospace, we're at about 71% in India, and we can go up to 75%. That's what we see in aerospace. 75% utilization is a kind of a optimum utilization, and we have some headroom. But we already started adding more capacity because, as you mentioned, it's a long gestation. When we win some contracts, it takes some time. Even getting the machines takes 12 months sometimes to get them on and implemented. So you will get up to 75%. At the same time, we start implementing more capacity to support the growth required, because you saw we grew 38% year on year. The growth is quite steep for us in aerospace side also. And the consumer side, it's a lumpy investment when you do this, consumer electronics especially. You need to make a full product required investment, and then then you start using the capacity utilization. So we start seeing this 31% moving up to 50 and getting 70-75%. We need to get up to 80% there. That's the maximum we can see in this industry. So that's how we see overall, getting up to in the consumer side of it. A little bit higher, but aerospace would typically keep certain buffer because we absorb a lot of new parts every on a quarterly basis. And that also shows in our total, we have more than 5,122 parts today operational in the business and in aerospace side.
Yes,
so that
Mr. Melligeri, there is a lot of complexity. For a stock market also, a lot of investors and stakeholders are listening right now about your company. There's a lot of components involved in the aerospace as well. I'm not going to get into the technical version of it, but just wanted to understand for our viewers is how Aequs is actually placed. You claim that you are having the entire integration with you. So when you have an entire integration, you already you have a very long standing relationship also with Airbus and Boeing as well. So does that become a moat for the company or the industry?
Yeah, one is working with the customer like Airbus and Boeing for a long period of time. Over 15 years, we have been working with Airbus. The second one is our capability, what we built in the ecosystem, all the way from when we started 15 years back. We were only doing 20% in-country value add. Today, we have gone up to in the products like wheels, 100% in-country value add. It has been in a constant journey to achieve this. When you have that kind of value add, where you have raw material, forging, machining, surface treatment, finishing the parts and shipping it to them. Today we do like aircraft wheels. There's almost 10% of the global aircraft wheels are manufactured out of Belgavi aerospace cluster. What we are doing today. So that kind of mode is something which we continue to build on that. So that value add concept, which where very critical for manufacturing. More value add you can do, more retention, more moat you can build with the customers.
Yes, that's pretty interesting, Mr. Melligeri. But current margin profile, value addition, so many levers and is coming from the management and the company in the con calls. Maybe 5 years down the line, your product mix changes, which we are talking about, will definitely change. Have you thought about what will be the consolidated margin levels aspirationally you are targeting?
If you really look at it, we are overall a precision manufacturing, aerospace or consumer electronics. What we are doing is very similar activity and similar kind of capital profile, deployment profile. So we'll end up with a similar margin profile at a 20% kind of ROC kind of a business with a 20% EBITDA. That's what we trying to shoot for. And aerospace is almost there at this stage today. As you saw, it's 19% ROC and about we're doing about 20+% EBITDA right now. So what we have shown in aerospace is pretty much achievable in consumer side also.
And a lot of JVs are there, and this type of industry, be it technical JV, it's imperative that it has to be there. But Mr. Melligeri, the question is on the defense part. There was an important, pact being announced. So in defense, which segments you will be getting, into this active mode?
If you really look at it today, we are already actively working on the defense side. We will do the pylons for LCAs on the component level and some assembly level. So whereas larger defense play, we wanted to get into the, especially unmanned aerial vehicle drones for India defense. And that's where this partnership came in. And we want to, as a system level play in the India defense, more of that. And today, for component level, we continue to support the customers, HAL, and various other customers, and continues to do that. That's very natural part of our business. But when we get into system level, this is a kind of partnership we needed where we can do technology transfers, where we're going to bring in and develop indigenous products, both design and manufacturing of the UAVs.
So there is a very interesting, takeaway coming recently from the Indian-European trade deal, especially with Indian companies having their own manufacturing setup. And I did check your numbers. One is there in France itself. Now what happens is, does that open up something bigger for the company? And that's actually needed.
Yeah, if you really look at it, we have certain capabilities in France, especially our capability on engine components and landing gears is predominantly work developed in France, and we slowly we're bringing that into India. And if you're coming back into the, we also do military work in France for the French government. For example, Rafale, we do some activities. But if you really look at this free trade agreement, which has played out, aerospace has always been no tariff both the ways, and it has no impact on aerospace specific. But whereas consumer side, there is some tariff, some of the products, especially on the consumer toy side of it, and that should have some tailwinds because of this FTA. Generally, customer pays for the tariff today, but that should make us more competitive when the tariff goes away. So against our regional competitors. And our European export is about 50% today. Is one of the big.
Yes, Mr. Melligeri, in case, there is a good tie-up with the French government and a very large aviation body of France, which we know what we are talking about. If they try to set up their shop here and you are their important partner, there is a chance, right? So what happens in that case?
Oh, look, I mean, we are married to a program, if you really look at it, Airbus A320, where the Airbus A320 is assembled in US or in France or Germany or in China today. Our parts go into those programs. We are a sole source on more than 90% of our parts we do, more than 5,000 parts we do. 90% of the parts we are sole source, single source globally. So that basically, irrespective of where they get assembled, we are the supplier for those parts, under the contract. So that basically gives us an opportunity to supply to the customer, irrespective of where they manufacture these final assemblies.
Mr. Melligeri, this is the last question for you. You are an industry stalwart also, and whenever I speak with people near the Bengaluru area of the aerospace, every time I get a very positive commentary from them. But your request, very short one on the budget expectations for your industry, what you're looking at.
Yeah, I mean, really look at one of the biggest thing, what I say for manufacturing industry overall, and especially aerospace, is cost of capital. And cost of doing business has to be, brought down. That's the only thing I would say specifically, whether it be a tax or cost of capital or ease of have access to the debt for the businesses. So that is very important for manufacturing to scale, because we are globally competing on these products, not necessarily within India, but globally. When the cost of capital, when the total cost of capital is significant in manufacturing compared to the services. So it's very important for government to focus on that element of it.
Yes, government as well as MNCs, that's what we'll be looking out for. But I'll just want to give a revision for all the earnings and ratings which we have given in KYC issue, and then we'll have one small question with Mr. Melligeri as well, since we have a little bit of time. Just wanted to show the income numbers, the balance sheet, that's where the strength is lying. The net debt equity ratio has come down. Cash flows also has been decent if you take the 9-month numbers. Return ratios, the company yet needs to prove. The ROC numbers need to come up for the other businesses as well. Street cred, it just IPO has come in, the stock is below that price, but net, it's a neutral rating. But remember, it's in a very fast growing segment. But if you're a long-term investor, high gestation period is there, then you'll understand the company more. Even the market will try to understand the company more, and that's what my duty is in KYC at NDTV Profit. KYC rating is 5 out of 8. Mr. Melligeri, just the last question, because order book is something which is very much important everywhere, especially in an industry like yours. To make it sound simpler for our stock markets, $814 million order book now. Anything else, you could give us a ballpark figure for maybe in the next 1 year, 2 year? How much will it be? 1.3, $1.5 billion? How much can it be?
Look, this is a constant evolution every month for us, every quarter. Because what happens, we win contracts. Typically, our contracts are 5 to 7 years when we win a contract. So pretty much they're locked in contract with our customers. So I mean, this numbers keeps changing literally every quarter. We'll update and publish that. Our goal is to continue to scale. If I'm going to grow at 20% plus every year on continuous basis, we have this order book has to increase for us, because it's a multiple of our yearly revenue when we look at it average basis.
Yes, thank you very much, Mr. Melligeri, for your views on that. And we understood how the entire market works in your industry, and hopefully the path to profitability does come by FY27. That's what the street is looking out for. But yes, thank you very much, sir. So thank you. So this was the management of Aequs, and the management is still hopeful to get the break even for FY27 for this company. But yes, aerospace, engineering, this is a long gestation period, so it will definitely test your patience as well in the markets. But that's all, folks, for KYC today. Stay tuned to NDTV Profit.